Welcome to Trader Pradesh.
Hey everybody, welcome back for another video. I get a lot of queries from a lot of people who don't want to study technical analysis much. They're just focused on getting a predefined trading strategy which they can use effectively in the market without looking at the charts much. For them, I have been studying a good strategy which has been giving a really good result, and it works a lot of times. I believe the probability of this particular strategy is close to around 65 to 70%. And I'll be discussing with you the strategy. It has simple entry and exit rules, and you can only apply this particular strategy when the market opens gap up or gap down. All right. See, whenever the market opens gap up or gap down, there is a very volatile nature of the market during the beginning half an hour or an hour. And in that period of time, if you place a trade, then you have a good probability of the market making a move towards your expected direction. So in this case, as you can see, these days Nifty and Bank Nifty have been creating gap up and gap down opening almost on a daily basis. So in this case, the first rule is that if the market opens gap up by more than 0.5%, so for example, if Bank Nifty opens gap up by more than 200 points, then only you can apply this strategy. And on the other hand, if Nifty opens gap up or gap down by more than 50 or 60 points, then only you should think of applying this particular strategy. Small gaps do not count in this strategy. So if Bank Nifty gaps down or gaps up by only 50-60 points, then avoid this strategy altogether. See, whenever the market is opening gap up or gap down, there are two possibilities: that the market might continue with the current trend. For example, if the market opens gap up, the chances are that the market might move higher, or the other possibility is that the market might go sideways the whole day. All right. So in this case, whenever you see the market opening gap up or gap down by more than 0.5%, you just have to follow this simple procedure. Just plot the 15-minute chart with a 20 exponential moving average. Why 20 exponential moving average? Because on intraday basis, the market usually gets a good support and resistance around the 20 moving average. So you can expect the market to stall around the moving average for a lot of times if you take a trade. So you just have to plot the 15-minute chart, and if the market gaps up or gaps down, you just have to watch the first 15-minute candle. So in this case, if the market opens gap up and it forms a bullish candle, for example, in this case, the market forms a bullish candle, then in these cases, what you can do is you can sell puts. You can sell at the money puts, you can sell puts below these levels with the stop loss at the low of these levels. All right, if the market comes below the low of this candlestick, the first 15-minute bar, then you exit your position and book the loss. All right, why selling puts? See, the idea behind selling puts is that during the first 15-30 minutes, the volatility is on a very higher side during that period. And if at that point of time you start to sell options, then with the passage of time, as the market starts to move sideways, the volatility reduces, and there's a concept called IV crush. The volatility starts to reduce very quickly, and that will give you a benefit if you sell a put, even if the market goes sideways. So, for example, in this case, the market formed a very big bullish candle, and the criteria is if it crosses the high of that candle, the first 15-minute candle, you sell puts below the strike price of these levels, and the stop loss will be the low of this candle. So, as you can see, the whole day the market is moving sideways, and the volatility crush will start to happen. And with the passage of time, you can see you'll start to see the benefit of the IV crush and the time decay. So this is a very handy strategy which you can apply. So in this case, you buy above a bullish candlestick and you sell below a bearish candlestick. So let's consider another scenario. So in this case, you can see the market opened gap down and the first candlestick is bearish. You can create a short position here. You can sell calls below. If the price goes below this candlestick, the stop loss above this candlestick. And you just hold your position, wait for the IV crush, and get the benefit of time decay. Here you can see the market open gap up, a bullish candlestick, the first 15-minute candlestick. You create a trade if the price crosses the high of this candlestick and enjoy the benefit of time decay and the volatility crush. Always remember, keep the stop loss below the low of the first 15-minute candle. So in this case, the gap is very big. The first 15-minute candle is bullish. You create a trade when the price crosses the high of it. It's a very effective technique, and it's based upon gap openings. And the first 15 minutes usually tell you who is on the stronger side, who is winning. You can see here, you can take a trade in the first 15-minute high crosses. You can create a trade, you can sell puts and stop loss below this level. You gap down with a bearish bar. You can sell calls if the price crosses this low. So you can see here, big gap up. You can create a put. You can sell put here, but at the same time, in this case, your stop loss will get hit. See, the effectiveness of this strategy is 6 to 7 times out of 10. It will work in your favor. See, the first 15-minute bar is a bearish bar. You start to sell calls when the price moves below it. The stop loss above this particular bar. So make sure the gap is big, and whatever bar is being formed in the first 15 minutes, if the bar is bullish, if it's a bullish candlestick, you sell put if the price crosses the high of that candlestick and stop loss below the low of that candlestick. All right. Here you can see the price open gap up, and you can sell a call if the price goes below the low of this candlestick. A bearish bar, you can sell below it, the stop loss above this. So it's an effective rule-based strategy, and you can backtest it on Nifty and Back Nifty and on the other stocks you are following. And you can also check its reliability, its effectiveness, and you can also add this particular strategy in your toolkit. So I hope this strategy will provide some sort of value to you in your trading. And if you find the video helpful, don't forget to like this and share it, and also comment your thoughts. Thank you very much and take care.